Welcome back to the street. We have a bit of breaking news for you, somewhat expected given the announcement yesterday from Canada's main banking regulator. We're seeing Manulife increase their dividend by 5 cents. The quarterly payout now going to 33 cents per share, marking roughly about a fifth of an increase, so about 18% overall for the quarterly payout, and that's going to be coming next month for anyone who is going to be buying shares in the insurer by the end of this month, by December 1st. Now, this is entirely within the context of the decision from the Office of the Regulator of Finance, I always love trying to get through these various terms for these folks, but the the superintendent. I always try and think of schools when I think of that, but this is the banks, folks. The Office of the Superintendent of Financial Institutions. I knew I'd get there. OSFI allowing big banks and insurers to raise dividends, and it seems that Manulife is the first to take advantage of that newly returned freedom. It dovetails quite nicely with the views of our featured guest this morning, Rob Tetreault, really making the case that it's almost impossible to find traditional fixed income assets these days. Rob is Senior Vice President and Portfolio Manager at Tetreault Wealth Advisory Group with Canaccord. Rob, good morning. Thanks so much for joining us.
Morning, Jameson. Great to be here on this Friday morning.
Absolutely. Well, is it a happy Friday for income-focused investors now that it seems like the banks are about to open up the spigots for them?
Yeah, I guess a lot of Canadians have been overweight Canadian banks for a very long time. I think of anyone kind of that went through some serious downturns. They went to safety. They flew back to what they knew, which was consistent yield and consistent appreciation of that dividend yield and constant increases. And we've kind of been out in the dark for increases now for, I think the last one was 2019. So we're going to see some increases. Manulife announced it. That was breaking news for me too. Thank you for breaking that for me, Jameson. But good to see OSFI moving off that, because this capital is a drag, right? This capital, anyone who's ever managed a portfolio knows that if you're carrying a bunch of capital, that's going to drag on your performance. These banks are effectively carrying cash on their portfolio, right? And it's dragging performance. Therefore, prudency says that you got to keep some cash, but you also need to appease the shareholders. So I think we're going to see some increases, Jameson. I think it's going to be kind of 13, 15, 18, 20% raises across the board for the Canadian dividends.
And how quickly do you expect that to come, given the fact that, as you note, and maybe some useful background for our viewers, is that OSFI put those restrictions in place largely out of fears that there would be a big wave of defaults related to the major job losses that we saw in the early months of the pandemic that quite, thankfully never ended up occurring. And so banks were left sitting, as you noted, Rob, on this big cash pile. And I have heard that expectation for between 20-25%. Is there a particular bank or financial institution that you think is in a better position to perhaps, juice those payouts even further?
I think we got to look at the payout ratios for that. And you're right. Back to your point about loan loss provisions, they put aside something like $20 billion of loan loss provisions, these banks, saying, what if, right? What if people start going bankrupt, corporations fail, businesses fail, individuals fail, loans fail, and they put aside $20 billion. And lo and behold, that just sat there. Not only that, loan revenue actually went up, right? Loans were solid through the pandemic and continue to be solid. So now you got like this $40 billion of cash. So you're right. They put aside this money and now they do need to put it back. The banks that I think are more likely, so you got to look at the payout ratio. The payout ratios, and I guess the payout ratio is the most important thing. Historic banks want to be between 40 and 50%. That's what they've always stated, and that's what I think we're going to finish. For example, if National were to increase kind of to 45%, you'd see the dividend yield go up to 99 cents. So that's a fairly significant increase. That's roughly 40% increase, but I don't think we're going to see that. I do think BMO and TD will likely be at the high end of the range, something like 20-ish% increase, but they also want to save some ammo, right, Jameson? They want to save some ammo for future dates where they could say another dividend increase.
Right. Yeah, they want to keep on making headlines on this very program, I would imagine. Rob, what about your view? I found it pretty fascinating when we were, getting prepared for this conversation. Was this look at alternatives investing? It's a pretty popular buzzword right now, but I love that you got really specific, looking at music royalties. How can investors play that?
Yeah, okay. Music royalties is one of the many alternatives that I believe Canadians should own, especially if you're looking to reduce volatility and get a traditional fixed income stream. 10-year yields are less than 2%. You got to pay tax. There's inflation. What are you left with? You got to pay your portfolio manager, a guy like me or someone. And what are you left with? You're left with nothing if you're buying 10-year twos. Also, what are you going to do if interest rates ever go up? If interest rates go from 2 to 3 on a 10-year and you're holding that, you're down 10%, Jameson, for the viewers at home, right? 1% for each year that you're down, roughly, ballpark, bond, corporate finance math for you guys. So do we want to own that? I don't know. Maybe for some investors, but for most investors, they need stability. They need uncorrelated asset classes, and they need consistent yield that's dependable. So we look at that. We think outside the box. We're not square peg, round hole here. We want to think, how do we generate that? And we can generate that. Music royalties, an example you gave, among the many others, but that's one. So, you end up owning a catalog of songs. Every time those songs get streamed, you get a piece of that revenue. It gets distributed to the unit holders. And if, Jameson, there's increase in streaming in the future, perhaps on video games or movies or apps or on your Peloton or whatever it may be, well, then the revenue base could actually increase. So we're targeting something conservative here in the kind of 7 to 9% range for income. It's not super tax efficient, but it is consistent and it is uncorrelated to the traditional stock markets.